single number, and then I want to explain why I think it is the most important number in this entire sector right now. 9.1%. That is where the mining sector currently sits when you measure it against gold itself. And for the last 13 years, that number has been trapped between roughly 5 and 8.5%. It has touched the ceiling of that range 3 separate times and been rejected every time. It is now above it. That is Michael Oliver's measurement from his own work, and he says openly that he does not know why other analysts are not showing this chart. Having spent time with it this week, neither do I. Because when you understand what that number actually measures and where it used to sit, the implication is not subtle. It points to mining shares delivering roughly double the gains of gold itself. Now, I have been building toward this on this channel for a while. I showed you that miners were earning record profits while trading near a 25-year low in valuation. I showed you Newmont hitting an all-time high while gold was still 20% below its own. Those were pieces. This is the piece that connects them, and it also answers a question I asked in that Newmont video and did not fully answer. Who was actually doing the buying? Because it is not who most people assume, and once you know, the whole move makes a different kind of sense. Quick question before I start. Right now, are you holding mining shares, or are you purely in physical metal? Just say miners or physical in the comments. I think this video is going to land very differently depending on your answer, and I want to see the split. This is the hidden economy. Subscribe our channel and let us get into it. Right, let me explain the measurement properly because everything else rests on it and it takes about 90 seconds. Take the Philadelphia Gold and Silver Miners Index. That is not an ETF, it is a proper index. And it has been running since the 1980s, which is exactly why it is useful. It gives you decades of history rather than a few years. Now divide that index into the price of 1 ounce of gold and express the answer as a percentage. What you have built is a ratio that tells you one thing. How does the market value the companies that produce the metal compared to the metal itself? And this is the part that matters. Because a mining share and a gold bar are two completely different objects. A gold bar is a thing. Its value is the gold price today, full stop. A mining share is a claim on future profits. Its value is whatever the market believes those companies will earn over the coming years. So this ratio is not really measuring price, it is measuring belief. When it rises, the market is saying it trusts the earnings. When it falls, the market is saying it does not believe the current metal price will last long enough to matter. Now look at what that belief has actually done over 4 decades. From the 1980s through to 2008, this ratio averaged around 25%. It moved between roughly 18 and 35. That was normal. For a quarter of a century, that was simply what the market thought mining companies were worth relative to the metal. Then it collapsed. It fell through 2008 and kept falling, and by the end of the bear market in 2015, it reached 4%. 4% against a decades-long average of 25. Oliver's reaction to that number is the correct one. He asks, essentially, what happened? Did we stop needing gold miners? Do we want the gold and not the companies that dig it? And since around 2013, it has been stuck in a narrow band, roughly 5% at the low end and 8.5% at the top. 13 years inside that box. It pushed the ceiling 3 times. It got knocked back 3 times. The last of those was February this year, when the miners peaked. The reading right now is 9.1%. It is out. So what does that actually mean in practical terms? And here is where the number gets interesting rather than just historical. The bottom of the old multi-decade range, the level this ratio spent 25 years never falling below, was 18%. We are at 9. So if this ratio simply travels back to the floor of where it used to live, the lowest end of what used to be normal, it doubles. And crucially, on the way there, it does not encounter any meaningful resistance. There's nothing between 9 and 18 because the market spent 13 years so far below that zone that no trading history exists in it. Oliver's point about the shape of the base is worth understanding too. A wide compressed base tends to produce a fast initial move because pressure has been building across a long period with nowhere to release. So the projection is this. In the next leg of this move, mining shares deliver roughly double the gains of gold. I want to be precise about what that is and is not, because this is where these numbers get abused. That is a measured move from a technical base. It is a projection derived from a chart pattern, not a law of markets and not a promise. Bases fail, breakouts get reclaimed. But it is a specific, checkable claim, and I would far rather have one of those than a vague number with no method behind it. Now, is there any evidence beyond the chart? Yes, and this is the part that made me take it seriously. 3 weeks ago, Oliver issued a buy signal on gold and silver, and he made a specific argument at the time. He said this rally would be different from the previous 2 over the past 6 months, both of which failed, rolled over, and made marginal new lows. He said this one would sustain. Now look at what the 2 largest names in the sector did. Newmont, the biggest gold miner in the world, and Wheaton Precious Metals, the biggest silver name, both exploded back to their all-time highs within those 3 weeks. During the interview, Newmont was in the process of attempting a new record close. And here is the detail I find most revealing. Oliver points out that if you look closely, roughly 5 or 6 trading days account for essentially the entire move. Not 3 weeks of steady accumulation, 5 or 6 sessions. His phrase for it is that it moved like a wet bar of soap, which is exactly what price does when there is far more demand than there is available supply at that moment. Which brings me to the question I left hanging in my last video, and the answer is genuinely the best insight in this whole interview. Who is buying? Oliver is direct about it. It is not the retail public. In his words, the public is still not interested and still doubtful about gold. I think that is right, and it matches everything I have shown you from the positioning data over the past few months. It is large asset managers, and his explanation of their reasoning is the part I want you to take away, because it is a mechanism rather than a story. Put yourself in the position of somebody running a large fund. You are looking at an expensive equity market, and you are becoming uncomfortable, so you want to move some money into something defensive. Historically, the answer was government bonds. That was the reflex. Stocks look risky, rotate into treasuries. That option has become considerably less attractive, for reasons I have covered extensively on this channel. Long-dated bonds have been a poor place to be, and confidence in government debt is visibly deteriorating, so the money looks at gold instead. But, and this is the crucial part, a large institution does not express that view by buying gold futures or options. That is not how those mandates work. Many of them are required to hold equities, so they buy the equity version of the exposure. And if you are running serious size, you do not go into small exploration companies. You cannot. The positions you need to build would not fit. You go to the largest, most liquid names in the sector, which is precisely why Newmont and Wheaton went vertical in 5 or 6 sessions, while retail sentiment stayed sour. That is what a forced allocation looks like. And I would add my own observation here because I think it matters for what comes next. This kind of buying is not sentiment-driven. It does not reverse because a headline is bad or an inflation print comes in hot. It is a reallocation decision, and those get implemented over quarters, not days. Now let me connect it upward, because none of this happens in isolation. The driver, in Oliver's framing and in mine, is the bond market rather than geopolitics. And he gives one detail here that I had not seen elsewhere and that I think is worth your attention. Last November, the head of the New York Federal Reserve said the Fed would begin buying bonds to provide liquidity to that market. Not to support it, note the language, liquidity. Since then, bond prices have fallen and yields have risen, so the intervention did not reverse anything. In Oliver's assessment, all it did was slow the process down, and the measure of how far that has gone is stark. Last month's closing level on 30-year Treasury bond futures was such that you have to go back 25 years to find one that low, which is to say, yields that high. His conclusion is that this is now outside the control of both the government and the Federal Reserve. They can intervene, and they will. He is explicit that he would not want to be short bonds, precisely because the authorities will come in his phrase, with guns blazing. But then he makes the point that turns the whole thing around, and it is the single cleanest sentence in the interview. The fact that they have to come in with guns blazing, meaning printing money, is itself the bullish case for gold. The intervention is not the rescue. The intervention is the confirmation. And there is a piece of institutional evidence supporting exactly that shift in thinking. The chief investment officer of Morgan Stanley moved away from the traditional 60-40 portfolio split to 60-20-20, stocks, bonds, and gold, a 20% gold allocation from a mainstream Wall Street institution. That is not a fringe position anymore, and I think a lot of people have not registered how significant that is. Now, silver, briefly but importantly, because Oliver prefers it and gives a technical reason I find persuasive. His broader observation is one I have covered before. Silver spent roughly half a century confined in a range while every other metal multiplied several times over. Copper averaged around $1 a pound in the 1980s and now sits around 6.5. Lead, zinc, aluminium, steel, gold, all multiplied. Silver did not. Then, late last year, it broke out, ran from around 50 to 100 and briefly to 121. And most people concluded that was the end of something. Oliver's reading is the opposite. He describes that spike as silver's opening statement rather than its conclusion. But the technical point is the one that actually matters, and it is this. If you plot silver against gold as a percentage on monthly closes, silver had been capped inside a range for years. That surge broke through the top of it. And here's the part that matters for anybody who has been sitting through the correction feeling that it undid everything. The pullback of the last several months caused silver to fall, but it did not take that relative breakout back. The structure held, And it is turning up again, so the price correction was real. The structural change underneath it was not undone. Now the honest section, and there's a fair amount. First, and most importantly, the timing window. Oliver does not describe this as a slow multi-year grind. He says the surge is likely to be spent mostly within the next 6 to 12 months, and that it will be quick. His words are essentially that you are either there or you are not. I want you to hold that carefully because it cuts two ways. If he is right about the direction, waiting is expensive. If he is wrong about the timing, and this takes 3 years instead of 1, then anybody who sizes a position around a 12-month window is going to be tested badly in the middle of it. Second, mining shares are not a safer version of gold. They are a leveraged version. The same characteristic that could produce double the gains of gold produces considerably worse than double the losses when it goes the other way. And they carry operational, political, and management risk that a bar of metal simply does not have. Third, the 18% figure is a measured move from a technical base. It tells you where the pattern points. It does not tell you it will get there, and it certainly does not tell you when. Fourth, disclosure. Oliver runs a paid research service, and the program this came from carries sponsorship from a market data platform. Neither of those makes the analysis wrong, and the chart is checkable by anybody, but you should always know. And what would change my view? If that ratio falls back below 8.5% and stays there, the breakout has failed, and this becomes the fourth rejection at the same ceiling rather than the escape. If Newmont and Wheaton give back these gains, the institutional buying thesis weakens badly. And if retail money floods in from here while the price stalls, then the asymmetry that makes this interesting is gone. This is not financial advice. I'm not a financial advisor, and you should do your own research. But hold the shape of it. A ratio that averaged 25% for a quarter of a century collapsed to 4, spent 13 years pinned near the floor, and has just broken above the ceiling of that range. The first level of any historical resistance is a doubling away. The two largest companies in the sector went to all-time highs in about 5 trading sessions. And the buying appears to be coming from institutions rather than the public, which means it is allocation rather than enthusiasm. The gold price tells you what has happened. This ratio is telling you what the market now believes will keep happening. So tell me down there, miners or physical? And second, on the record, does that ratio hold above 8.5% at the end of next month? Yes or no, and say why. I read every one of these, and the sharpest get pinned. See you in